So the weighted average cost of capital is based on the required rate of returns for shareholders and lenders. It's basically what rate of return do you need to give to your owners and what rate of return do you need to give to the people or the companies or the banks that lend you money. So in the first tutorial, we figured out the cost of equity, right? The rate of return that we're required to give our shareholders, or at least what they expect, because firms don't actually have to pay the shareholders. Shareholders are residual claimants. They sort of get what's left over. Debt's different because you have to pay your lenders or else you face bankruptcy. So this tutorial, we're going to look at calculating the cost of debt, otherwise known as our interest rate that we need to pay the entities that loan us money. In the interest of space, I'm going to hide this section. I want to have only the cost of debt showing. So I right click and I go to hide and I'll hide these cells, and then you can see this blue line between 6 and 31. To unhide it, you highlight both and then go to unhide. There it is. I'll undo that. Okay, here we are. Calculating the cost of debt. This is where we're going to go and use our as reported and standardized statements. And every firm is different. We're not using Yahoo for this because the numbers in Yahoo are not always the same as the numbers in Mergent, and it's much easier if we're consistent. So our homework had us use Yahoo Finance, but this is going to have us use Mergent. So the first thing we need to do is figure out how much debt we have. And as you probably remember from accounting, debt on the balance sheet that bears interest, right? You don't have to pay interest on accounts receivable, but you do have to pay interest on both short-term and long-term debt. So we need to get both short-term and long-term debt. Start at your standardized statement. So you'll have your income statement on the top and your balance sheet next, followed by your statement of cash flows. And you're going to be looking for your current debt and your long-term debt. So Hershey's has current debt. There it is, just underneath accounts payable and accrued expenses. Current debt is either the part of our long-term debt we've got to pay this year, or it might be a line of credit, something like that. Copy it and bring it over here to your weighted average cost of capital and put it at the top. Then we need to get our long-term debt, not dividend history. And that's probably called long-term debt and leases, long-term obligations. And we're going to copy that and bring it over. So this is nice because we can use this to tell how much debt the company had that they're paying interest on, right? They're paying interest on the things that they need to pay this year, and they're paying interest on the things that they pay over the long term. The next thing we need is to figure out how much interest they're paying on debt. If you go to your standardized statement and you go up to your income statement and you see interest, the only item for interest is interest income. It's probably this way in your company, but it might not necessarily be. And it's a negative number, indicating that they had a negative interest income, which means an interest expense. It's a tricky way to say they paid interest. This interest income number is the amount of interest they paid plus the amount of interest they earned. So we can't use this number to figure out what our interest rate is on our debt because that's not the total amount. You probably will need to go to as reported. And if you go to as reported, we're going to look for interest expense, something that tells you what you paid in interest, right? And Hershey's happens to have 3 lines, these 3 here. Interest expense gross. So in total, they paid $91,514. Then they have interest income, $3,158. And their net interest, the interest they earned minus the interest they paid, is going to be a negative number because the expense is greater than the income. Well, net is what's expressed on the standardized statement, but what we're really interested in is this gross number. That's the amount of interest that this company paid. If you're a company, if you're looking at your balance sheet and you don't have this, there's a tutorial on calculating net interest, and you can use that. So I'm going to copy that and bring it over. I'm going to skip a line and put it here. Okay, here's all the information that we need. Just to make my calculating easier, I'm going to delete all of these rows or columns, all those cells. I'll delete them and have them shifted to the left. Perfect. So here is going to be a new line, total debt. This is their amount of debt, their long-term debt plus their short-term debt. And I'm just going to use the sum function, add both of those two together. And then I can click on it, search for that black arrow, and drag it over. This is their total amount of debt. I'm going to format it using a top and a double bottom border. You don't have to, you can do it however you want. But this lets me see easily the amount of debt that they have. And then I use this to calculate their interest rate, which is the same thing as cost of debt, or rate of return, or required rate of return on debt. So all of those names are synonymous. And the way we calculate that is by taking the interest expense, the gross interest expense, and dividing it by the total debt. And that's just asking us what percentage of that total debt was paid out as interest. And that is equal to 0.046, otherwise known as 4.664%. Drag it over and get those numbers. Hope they look kind of alike. If you get a 14% and a 2% and a 6% and a 3% and an 82% or whatever, you might want to average them. If you have a question, email me. However, usually in an environment where the interest rates here, it seems to be kind of declining over time. That makes sense given current, interest rate environments. We're going to use that as our cost of debt. The only thing left that I did not do is add the dates here. 2013, oops. And please put your dates. It makes my life a lot easier when grading your projects. Formatting counts. How it looks counts. So that's our cost of debt. There you go. You did it. If you have a question, send me your spreadsheet and say, tell me, what do you recommend I use for cost of debt? And then I can get back to you and let you know. But most of the time, I'd say 90% of the time, it's just the most current value. Don't forget to save your file, save it early, save it often, and I'll see you next tutorial.